Hi, good afternoon, everyone. I'm Nicole from the Institute of Banking and Finance, and I'm delighted that you are able to join us for this IBF Masterclass, jointly organized with Thought Machine, where we will look at digital banking, imagining future trends. Mr. Nicholas Wild, APAC Managing Director at Thought Machine, and Mr. Kelvin Tan, Managing Director and Global Lead at Nexus Standard Chartered Bank, will be leading today's session. Before I invite Nicholas and Kelvin to take the lead in today's session, allow me to do a very brief intro to the Institute of Banking and Finance and the resources we have to help professionals in the financial industry. IBF was established by the MAS in 1974 as a training provider to provide functional training for the financial industry. Since then, our role has evolved into one of standard setting for financial services sector skills and competencies. Since August 2018, we also expanded our mandate to cover career advisory and job matching functions for the financial services sector. We have thus adopted an integrated approach to skills development and jobs for the financial services sector. Here's a quick look at our services and how we support the industry across training, recruitment, and workforce transformation. You can find out more about our services and connect with us on any of these areas via our IBF website. We have also put in place enhanced training support for the financial industry to further alleviate training costs during this period. The enhanced course fees subsidies are part of MAS's support package that was announced in April last year to sustain and strengthen capabilities in the Singapore financial services and fintech sectors amid the current economic downturn. The aim of the enhanced training support is to encourage more companies to send their employees for training and upskilling so that they are in a better position to help the company move forward when economic activity normalizes. For the rest of the year, we have raised funding support for training to 95% across the board for all FTS and IBF STS programs, subject to prevailing grant caps. The funding quantum will be reduced to 90% next year before going back down to pre-crisis levels in 2022. You can find more details on the enhanced training support page on the IBF website. In addition, IBF will also be supplementing the commercial training available with free webinars during this period to support the training needs of the industry. Financial professionals can also tap on the Learn at IBF mobile learning app for bite-sized learning at your own leisure. All these are complimentary and are accorded with CPD hours. That concludes my short intro. I'll now hand over the time to Nicholas and Kelvin.
Thank you. Oh, no. Okay. Unfortunately, it looks like first technical hitch, which is you'll get to look at Kelvin's handsome face, and I'll continue to be a man of mystery. So, thank you very much for the intro. My name is Nick Wild, and as was stated, the Managing Director of Thought Machine here in Asia Pacific. We're a cloud-native, cloud-agnostic, real-time core, uniquely architected from the ground up as a platform. There we go. We're back. Excellent. As a platform. This session, however, won't be focused specifically on a solution or going into it. We're rather here to look at some of the bigger picture surrounding digital transformation in the future. And to help me do that, I'm delighted to say I have Kelvin Tan here, MD and Global Lead for Standard Chartered Bank's Nexus, which is already making waves in the region, and we will definitely be digging into what Nexus is further into the chat. So welcome, Kelvin.
Thank you, Nick. Thank you. Very happy to be here. It's a real privilege when Nick asked me to come and sit down with him and have a chat. I mean, the two of us are kind of mates outside of this as well, so it's going to be good fun for the next couple of minutes.
I hope so. Yeah, it's certainly going to be more interesting having you on than just listening to me talk for 50 minutes. So we will try.
When your video came up, the good-looking quotient on this call went up by about 200%. So I think we'll be fine.
Okay. So let's kick off by talking about some of the driving market drivers forcing transformation in the banking arena. I mean, COVID has been mentioned as the intro to this, and we're obviously all distressingly familiar with the impact it's had. including the banking domain, and you hear quotes and sound bites such as, "We did 2 years of digital transformation in 3 months." Kelvin, as you think about some of the other pressures on banks outside of COVID, do you think transformation is going to slow down once COVID is under control, or is the current momentum going to remain? And what do you think the key forces will be driving that?
Well, I certainly think that the momentum around digital transformation will continue unabated. It will, in fact, likely to be increased. COVID has actually created a significant spark for that momentum, given the fact that human interaction becomes increasingly scarce, and everything has pretty much moved digital, both on the corporate as well as the retail and commercial banking side of things. And the advent of large ecosystems in the last 2 years, having offered their own financial services to some extent in various guises on their platforms, have also put some pressure on the banks themselves to try to change things much faster. So I actually think the momentum will keep increasing. At a high level, in my mind, there are 3 main factors to drive the momentum of digitalization of banking and business models in general for banking. One of which is a technological one, under which there are many subcategories, right? But the key ones is the fact that APIs are now widespread and commonly used for data exchange and services provision. Data infrastructure in and of itself has been expounded, right? It's no longer a case whereby you are stuck with a legacy mainframe. Everything is cloud native. You put things onto a public cloud with the right security infrastructure, and it allows you to scale nodes, multiple nodes at the same time, which therefore means you're able to concurrently run tens of millions of transactions as opposed to tens of thousands of transactions without having to build out new data centers. So that completely changes the game from a technical standpoint of what is possible from a digital or digitization of banking services and banking business models. The second thing that really helps things is the fact that with the challenges, with the ecosystems, with the various buy now, pay later schemes running around, the challenge for traditional incumbent retail MSMEs and to some extent corporate banking is to solve the question, right? How do we gain the kind of scale that these ecosystems have without having to go through the pain and the cost of gaining that kind of scale? I think that will keep driving momentum on digital ecosystem and digitization on banking services. And the final one is, I think we are at the cusp of looking at a generational change of some sort. This might take a long time, 15, 20 years, but Nick, as you and I both know, we are no longer the dominant people in the workforce, right? So millennials are now approaching 30-40% of the workforce, and some of them are in their 30s, right? And that's going to massively change the trust equation from a banking standpoint. You would say that the people with the money now still trust the incumbent banks and institutional organizations. That may not be true 15, 20 years from now. So we are on the cusp of that generational change, I feel.
Yeah.
So that for me are the 3 big things.
Yeah, no, good points. I mean, the one that is kind of has had my kind of attention for the last year or so is regulatory. I mean, regulators for years, I think, have been seen as generally behind the times, arriving to when the horses, to close the stable when the horse has already bolted. And in some countries and in some cases, they're seen as being in the pocket of big banks and not really kind of looking after the consumer. But I think that's really, I'm not sure that's ever been true generally. But I think it's changing significantly. And we're seeing across the world a new level of activism by regulators on behalf of the consumer with the introduction of things like digital banking licenses, as we have just gone through here in Singapore, to allow new entrants a soft on-ramp or an easier on-ramp. But for me, I think the biggest change is around open banking. And the reason I think that's going to be such a revolutionary change, even though it hasn't necessarily had that big an impact yet, is because if you look at most markets, there are a set of dominant banks, and in some countries, it can be 3 or 4, and in others it can be sort of 6 or 8. But if we take Australia, for example, as an example, there's 4 big banks there that control probably 80, maybe even 90% of the banking, and that kind of oligopoly, it has to naturally lower the level of competition, and over time, customer value propositions sort of tend to deteriorate towards a largely homogenous norm, and then periodically, the public will uprise when something's happened and call for the government to intervene and break them up. Now, given the systemic importance of banks to economies and the risk that major change, often unintended consequences that new policies create, then governments tend to fiddle around the edges. Also, despite digital banking licenses, I think we're also seeing it's very hard for new entrants, new digital banks to gain serious traction. And for me, that's often because in order to move from your existing bank to a new digital bank, you're often required to provide large quantities of information, and who can be bothered. But if you introduce something like consumer data rights, open banking, as in Australia, all of a sudden you don't have to break them up because you're opening them up. And increasingly, banking is data, right? And I genuinely think that CDR and open banking is going to do more than just the digital banking licenses has done, especially if you start to extend that beyond just the open banking regime and say, like consumer data rights in Australia, it will travel across multiple verticals. So you sometimes see banks now kind of offering services to SMEs, let's say, payroll services or accounting services, partnering up. What you now potentially have with what you've talked about with the tech and the ecosystems and then open banking, digital banking licenses, is you could see payroll companies offering banking services, right? I mean, I think it opens up the future over the next, and again, I don't think it's next year, but 3, 5, 10 years, you will see a radical increase in this, in what you've talked about in the ecosystem space, and the technology, supports that. So, I mean, is that how you see kind of ecosystems and open banking, or do you think I'm overstating the case?
Well, Nick, I think that the open banking implementation would certainly change the name of the game. I mean, it's not made the foundations of banking shake the way it's supposed to have done in the UK and arguably in Australia at this point. And largely, I believe it boils down to 2 main factors. One is, as you've rightly pointed out, the predominance of large banks, large domestic banks in those regions. And obviously, the large domestic banks have very little incentive to submit themselves to the open banking regime as it has been established, or it has been spelled out in the UK and in Australia. So adoption will take some time. It's not going to happen overnight, but it will happen, I believe, the way you've established that, or at least you hypothesize that it will happen in the next 10, 15 years. The second one is really, the fact is the biggest buyers of open banking and consumer data rights and the ones who would move their accounts to the Monzos or the Starlings of the world are also the same guys with the least amount of money, which is the generational change issue, right? At the end of the day, people our age, I would like to say, and above, it's going to find it difficult. One of the key reasons digital banks today are not profitable, despite Revolut's attempts at profitability in yesterday's news, is really the fact that customer acquisition and servicing, even though the cost is significantly lower versus an incumbent bank, the lifetime profitability of a singular customer in the standalone digital bank is just not there yet, because most of your customers are millennials who do not either have enough liabilities or who do not use enough banking services at a large enough scale for it to be profitable at this point in time, and not enough to offset anyway the cost of the acquisition. Because think about it in simple terms, right? Yes, the cost of acquisition is lower than the traditional banks, probably about 20 or £20 to £100 to £200. However, someone who opens a Monzo bank account is probably using it as an accessory, and I will put $500 in it or £500 in it, as opposed to putting my life savings into that, or taking off or creating an entirely embedded lifestyle from a financial services consumption standpoint. So it will take a while to get there, but with the advent of open banking sowing the seeds for this in the long run, yes, I do agree with your hypothesis. We just don't know how long it will take, and if that generational shift will happen.
Yeah. Okay. No, I think that's true. I mean, I think we'll get to the end and talk about sort of speed of disruption and things like that, because I think that is a key point. There are, certainly as I talk to banks, there are sort of two distinct camps. There are those that feel a real sense of urgency, even though, as you say, the neo challenger banks kind of often have kind of under-delivered or certainly haven't met the promise. And sorry, I've lost my train of thought. But I mean, I think I think in general, what you say is true, and I've switched across the slide. I mean, the point about the accessory is good. It's one of my favourite quotes from Ron Shevlin, who's the snarkitect in the US. Very, very smart man, very, very keen observer of banking trends, largely US, but it does apply around the world. And I think a lot of digital banks, and there are a lot of them. This is a subset, and their ranks continue to grow. But although these were supposed to deal death to the incumbent banks, for the last 20 years, along with their more narrowly focused fintech brethren. And there are successes like Revolut and Tinkoff and Kakao Bank, but they're not that prevalent. And in Australia, we've seen one of the main well-funded challengers shut down and another sell itself off to one of the big four incumbents. So it does seem that these banks are a little more than a fashion accessory to most people's mains banks. They give a funky app and a flashy card, but their path to becoming major players still seems to me unclear or difficult. And with the sums of money they've been raising, it doesn't seem like a lack of capital is the challenge. So what do you think the key challenge is that they're facing, and what do you think it takes for them to be able to be, to become the next Standard Chartered or the next, Lloyds Bank or Commonwealth Bank of Australia?
So I would like to bring some nuance to this picture, right? If you look at the banks that are successful, when I define successful as either profitable or having a path to profitability at scale, WeBank, Kakao, Starling to some extent, Nubank, and a whole bunch of other players in the US, right? Oak North, what's the other one? I can't remember the name of the other one. But the point is,
Chime.
Most of them are Chime. That's right. Most of them are, and Solaris to some extent, very not yet as big. But the point here is, most of these guys are successful because they play ecosystem banking. They are not standalone digital banks and a separate and distinct app in and of itself that operates by all considerations from the consumers and the business perspective, like any other bank, other than the fact that it has no branches and it's digital. Now, take those guys out, right? Those guys have a different business model from a Monzo or a Revolut or a Nubank. So outside, I believe that the ecosystem play is the real scale game here, and the real ability for these players to get to high level of profitabilities and displace incumbents in the long run if they play it right. The only warning shot I see from standalone digital banks, a separate digital bank, is Nubank. Nubank in Brazil is the warning shot to the world. That business model can work at scale. 40 million, if I'm not wrong, at last count of number of customers, and turned profitable about 6 months, a year ago, give or take. And I believe that's what we are looking to replicate in some of these markets, right, with the digital banking licenses. In Hong Kong, MOX, for example, is something that we are looking to do to replicate from a Nubank success story standpoint, if I'm not wrong. But various business models will dominate, right? In Singapore, the Grab Singtel alliance will lead to a more ecosystem kind of play, because obviously Singtel and Grab combined ecosystem will impact 90% of the bankable population in Singapore. So it does depend, and that's the nuance I like to bring to this. If you look at your digital bank as a standalone bank with its own app and pretty much nothing else, then yes, I think that's a struggle other than Nubank. If you look at your digital bank as something that's embedded in ecosystem, so in China, you could take a loan from WeBank at an automobile leasing shop, and you would have never known it because WeBank is embedded so deeply into that process. Yeah, with that at scale, certainly more than able to threaten incumbents or displace them over time.
Yeah, yeah. I mean, the whole super app thing does at the moment seem to be a uniquely Chinese success story, right? I mean, there are some some organizations here in ASEAN and around the world trying to get to super app status, but they don't seem to have quite cut it. What's your thought on the super? I completely agree with the ecosystem thing. I don't think you're suggesting that ecosystem automatically equals super app. But I mean, what is your thought about, why isn't WeBank kind of everywhere? Why isn't Ant Financial everywhere?
And why is it Ant Financial everywhere in ASEAN or in China?
Why does it seem that they can't get, the super app doesn't get the success outside of China that it's had inside? Is it just a question of time, or do you think there are?
Well, I mean, look, think about where they started, right? Alibaba started with e-commerce in China. They were first movers. There was no other resistance. There was no one else there. The regulator had no idea what was going on until they became big enough. So they had a lot of space and to grow that ecosystem. They started with the e-commerce, then they spun off the financial services portion into Ant, and Ant became the predominant wallet together with WeChat and Tencent across the country, right? It's pretty much 50-50, 60-40 kind of split in China. But by the time they were mature enough to try to come out and take on Southeast Asia, the ecosystem in Southeast Asia is already there. So there are competitors. So rather than do that, they've decided to essentially take stakes and buy majority controlling interest in some of these players, right? Tencent funds C Group, and Ant funds or Alibaba funds quite a number of the e-commerce platforms in Southeast Asia, ranging from, if I'm not wrong, Tokopedia previously to Lazada and so on and so forth. So I guess it's a matter of a different context. Now, Southeast Asia is too disparate versus a Chinese ecosystem whereby there were no players to begin with. In order for Southeast Asia to have a predominant super app, you would argue that Grab is the closest to it. But from that perspective, Grab's super app status is based off a ride-hailing and a food delivery play, none of which in its own standalone vertical has ever proven to be profitable anywhere in the world.
Yeah.
Which is why they're steering to financial services, which is why they're steering to financial services and e-commerce, right? To try to build their embedded a bit better in the region. I mean, time will tell if they are successful, but that's the reason I think why Ant and Tencent essentially didn't propagate the same way they did in China. It was a different context. There were different players, and the best way forward was this. And not to mention the fact that even wallet providers across the region in multiple small countries require to go through the same painful process of acquiring a license capability to be able to provide the services that they provide in China.
Right, makes sense. So I mean, the message is just because WeChat and haven't taken over Southeast Asia doesn't mean the incumbents can relax and figure that the threat isn't there. So, okay, yeah. I mean, it is interesting. Obviously, in the game that we're in, Thought Machine focuses a lot on working with with the large incumbent banks around transformation and modernization of their stack, but we do get involved with digital and neobanks as well. it's interesting to kind of talk and study, because I think there are some organizations that I talk to, maybe unfairly, but it feels like their ethos is grow at any cost while there is plenty of cheap money around. And either the path to profitability will present itself at some point in the future, or somebody will buy us and we won't have to worry about it, sort of thing. Whereas there are, a whole bunch of other organizations, whereas I talk to them about, their plans and their path to growth and all the rest of it. I mean, it just sounds like kind of good, sound business sense, which, start with a clear target in mind that will be able to support, profitability from that segment. And if we look at Mox, you mentioned Mox earlier on, another Stanchar thing. I mean, Mox very clearly targeted the segment it was after. It is actually a segment with quite a lot of competition. It wasn't an ignored segment per se, but Dennis and the team had a very, very clear view that they could do something truly different, and that segment alone, properly serviced, could be profitable. Then build the tech stack to enable the business model as efficiently as possible. So again, if I look at Mox and not giving any kind of secrets away, it seems to me that what Dennis has kept in-house is the customer experience piece. It's the data, it's the analytics to help better understand what customers need and how they're behaving. It's creating the channel and the customer experience and the API and creating the product. It's the product factory and the creatives all kept in touch. And then using the API and cloud economy to obtain the essential utilities, but nonetheless they are utility, they're not differentiating. So general ledger as a service, anti-money laundering as a service, those the service desk as a service, those kinds of things. So use low-cost options for the essential but non-differentials. Data is kind of utterly critical, not just in gathering it, but in using it. And whilst I'm far from a Tesla fan, one of the things that caught my eye in an article a few weeks ago was they capture 10 times the data about remote driving, about automatic driving than any of their competitors do on autonomous driving. So they're capturing and using 10 times the data. And I think the data advantage, the ones that really, really get hold of this, that can lead to kind of substantial, a substantial win or take all kind of economics. I think the other thing that I'm seeing is these neobanks that adopt the attitude that they are primarily a tech company offering financial services, and they are measuring themselves against the way that Amazon and Netflix and all of the usual heroes of the tech world are done. I mean, I think the other smart piece about that is obviously if you get valued, if you get your valuations as a tech company instead of just against your normal balance sheet, you're getting higher multiples. And then there's this thing around the direct relationship with the customer. And creating an exceptional experience that leads to referrals and cross-selling and all the, all the normal stuff that a bank wants to do, and that all gathers into a very solid commercial focus. So when I talk to the organisations, the neobanks and the startups that I personally, for what it's worth, think are going to succeed, it's very much like talking to bankers like yourself in big incumbent organizations, right? It's about building a sustainable business. Whereas you do talk to some organizations and it's just, hey, Nick, if we need another $1 billion, we'll go and get another $1 billion sort of thing. So I do think there's been some what shall I call it, sort of nonsensible money available. I think that, you know, there's so much money swirling about. I think that will shake out, and we are, you know, as we've seen in Australia, I think we'll see a broader shakeout around the world. Do you, you know, is that your sense as well?
Absolutely. I think the most interesting bit about the fact that there's so many different kinds of digital banks running around is that it's a test of differing business models. Even in Australia, right, the digital bank that has prospered the most is Judo, which is specifically SME focused, has a very specific value proposition, has a very specific business case, and they have decided to not go the way of the mass market Zinja play, gathering deposits without giving loans, or the 86-400 play. So Judo has been successful because they have a different business model from the rest, and was very focused in executing it. You could say the same of Kakao, WeBank, Solaris, N26 to some extent, Nubank, different within Brazil. So from a Standard Chartered perspective, I just want to bring this back a little bit from the bank standpoint. Both Mox and Nexus are essentially that. We are large-scale disruptive experiments that the bank is conducting with two different business models. One is a digital bank in Hong Kong with its own license, with its own entity, specifically targeting a very specific segment and creating a CVP and a use case for that segment with a view on long-term sustainability and profitability. The second, which is Nexus, is embedding the bank, SCB itself, via a new technology stack into other people's ecosystems. And as most people would know, Bukalapak is our first partner in Indonesia. The e-commerce player is going to go live very, very soon, subject to regulatory approval at this point, such that they essentially will be running their own bank on the back of Standard Chartered's infrastructure. It's what we call banking as a service in the simplest terms possible.
Right. Right. Okay. No, it makes a heap of sense. So I mean, kind of switching now to the incumbents. I mean, there have been all sorts of gloomy predictions, as I said at the beginning of the session, on the future incumbent banks. I mean, Bill Gates, for all his current troubles, I mean, you know, definitely a smart man. And in the 90s, kicked off the 90s with the statement of, we need banking, we don't need banks. And the sort of the slide in the top right that you can see was around every fintech conference for about 10 years about, you know, how fintechs were going to unbundle banks, and, you know, they were dead and we didn't need them and all that sort of thing. And then you see, you know, Google Pay and the Plex Pay and Apple Pay and all those sorts of things. They, as we said before, there are definitely pressures. I mean, what if the neobanks at the moment have failed to kind of create that threat, or that immediate threat? And you've mentioned ecosystems. I mean, what do you see as some of the key challenges for an incumbent bank, whether Stanchar or just talk generally, in navigating, you know, the next 3 to 5 years and the threat of ecosystems? You know, what are some of the headwinds and challenges, and what are some of the actions they need to take?
Yeah, I mean, with all due respect to Bill Gates, I don't think he was very specific in his statement. I think Plex, Apple Pay, Amazon to a large extent demonstrate the requirements for the banks to be the underlying infrastructure. What he really meant was that we don't need banks to be the customer interface anymore. I think if you were to be very specific about what he's saying. Look at what's happened since Bill made that statement from the 90s to today, right? The fintech players that were supposed to disrupt banking have turned into vendors for banks. Essentially, like you rightly pointed out, Nick, the stuff that is largely commoditized and can be done in a better, cheaper manner by the fintechs should be done by the fintechs, and the banks should actively try to remove those pieces from the tech infrastructure and work with the fintechs to provide a better experience for the customers. in the same vein, the stuff that is better done by the big tech guys on the front end, right, which is in this case Google Plex, Apple Pay, Amazon, I mean even locally, like I said, our partnership with Bukalapak and so on, should be done by those players. They are far better at customer experience. They're far better at UI UX. Perhaps we should outsource it to them. Banks continue to play the fundamental role as the intermediary. The question, in my mind, is whether or not the neobanks that are coming up can play that intermediary role. Not sure. I wouldn't hypothesize what the end state of that battle will look like, but it's certainly worthwhile to think about. Perhaps the best response for incumbent banks is to build that capability to become that intermediary, to become the pipes. And I know legacy or traditional bankers would say, does that not make us a dumb pipe? I will beg to differ, and I'll go into a little bit more on that in a couple of minutes. But more importantly, once you become the access infrastructure, you will power Apple Pay the same way Goldman Sachs has powered Apple Bank or Apple Card. You will power whatever, right? Lazada, you will power Facebook, you will power LinkedIn, for all the banking and financial services that these people would seek to do. So again, back to Bill, it's not that we need banking and we don't need banks anymore. We need banking and we need the bank infrastructure, but we don't need banks to interface directly with the customers anymore. I think would be a more realistic quote from them.
Right. But what, I mean, I find that really interesting about being the intermediary, because I mean, I've certainly talked to a number of bankers in incumbent banks, and that thought terrifies them, right? I mean, so if you said that we ended up with, you know, Apple, Google, and Amazon being the primary interface for 60% of the world's population, I mean, they could turn to, you know, a dozen banks in the world and just say, okay, you guys fight it out over price, right? And so, you know, let's pick Standard Chartered. Standard Chartered could suddenly find that although Goldman Sachs isn't in most of its markets, all of a sudden it is, because it's backing Apple Pay, you know, those kind of things. So I mean, how, and then, you know, if indeed, you know, data is the future combat field of banking and every other customer experience, being disintermediated from that end customer and only receiving the data that somebody like a Google Plex or somebody would give you. I mean, why does that not, that doesn't seem to terrify you? You've obviously got a slightly kind of different, or maybe a more developed view on that.
I think it's an arms race. I think the first guys who solve this at scale, the ability to power any of these players at scale, will win the battle, right? There will be a whole bunch of cannibalization to go on, and then the whole bunch of banks who may not survive the next 20 years are trying to be intermediaries. The guys who built this successfully first will be able to do this. So you cite the example of Goldman and Apple, right? So let's say Apple wants to roll out Apple Card and Apple Bank in multiple countries on the back of their experience with Goldman in the US, which is a huge market, right? But Goldman is not going to go out there and get 40, 50, 60 different licenses across the world where Apple is present. In order for Goldman to do that, it is a huge investment, and it will take, what, a decade, two, maybe? Assuming they concurrently apply for licenses in 10 different markets at the same time, which, as you and I both know, I mean, look at how long it took for a digital banking license to happen in Singapore, right? And which is one of the most progressive regulatory regimes in the world, much less if you had this conversation in Iran or Iraq or Saudi Arabia or so on and so forth. Now, so I don't think that's going to happen. I think if one of the big players, the Standard Chartered, the cities and the HSBCs, get their act together and really build out that capability at scale, multi-market, across all the licensed countries that they have, then it becomes a very interesting proposition, I think, as a partnership between the fintechs, the consumer-facing or the customer-facing, I wouldn't say consumer specifically, but customer-facing interfaces of the big tech and the banks being the intermediary. So coming back to your comment on being the intermediary and being the dumb pipes and data, which ties in really well. One of the key things most people don't think about, and which is why bankers tend to be fearful of becoming the dumb pipes and the intermediary, is this, right? Yes, we we get access to the data the partner, in this case, Bukalapak in Indonesia, gives us, right? Which is quite a lot of data, by the way, of any e-commerce platform. So Nick, you would know, right? You would know what information your e-commerce platform has on you. They've got your device location data for the last 2 years. They know where you send all your packages. They know where you log in. They know where you log out. They know how you buy, how you pay, so on and so forth. Imagine having access to one partner's data. How would that change the way a bank would onboard or underwrite you? Now, stretch that imagination a little further, right? The platform is ready. You are the dominant bank with that platform, and you now power multiple front-end platforms and their banking services. So now I'm not only able to see Nick on, say, Google, I will be able to see Nick on Lazada. I will be able to see Nick on Shopee, which is the point of the illustration on the slide. How would that fundamentally change a number of things? 2 things that are legacy and 1 thing that is a frontier conversation. The legacy bits, it will change the way I will onboard Nick. Say, maybe not Nick, maybe someone who lives in the middle of rural Indonesia or second-tier city Indonesia. One of the key problems is address verification, right? We generally, for a high-ticket loan, people send individuals to physical addresses to try to verify that people live there. Now, if I know where your phone has been for the last 2 years between the hours of 12 a.m. and 6 a.m. every day, at 85% of the time it's at the same location, and I cross-reference that to where you deliver your packages across multiple purchases, and 85% of the time you deliver to the same address, and it happens to be the same address your phone is at, could I not then take that as verification of address rather than having to spend money and send physical verifiers down? And that's one use case. Think of the multitude of use cases that could come from having access to that data, both from an onboarding and underwriting standpoint. The third piece, which is slightly more frontier, and this is the one that shifts and blows the mind of people a little bit. And to be fair, even I am struggling to convince everyone about this one. But when the bank as the intermediary, a successful scaled intermediary happens and has access to all of that information about the individual, what kind of data products can the bank turn out to change the way we do, or banks make revenue, or banks generate business lines? What happens if we can pay customers for access to their data? Meaning, if Pepsi wanted to run a marketing campaign and wanted to target handsome Caucasian men in their age between 35 and 45, I'm talking about you, Nick, then what happens is that, all right, you want to know how you can market to them, what their consumption is like, where they deliver whatever data you want from this, great. We'll notify Nick to say, look, there's a campaign going on. They want access to your data. They would pay you $10 for access to that data, right? And this is a bit far out, but I'm thinking about, they'll pay you $10 for access to that data that you already have with us on the platform. Here's $10 if you say yes to it, and we'll just credit it to your account. And as the bank, you create a new revenue line immediately, right? Potentially with access to the data across multiple platforms as a successful scale intermediary. So I think that there is going to be some consolidation of the industry in the longer run, and not many people will be able to pull this off at scale. The question is, who does it first?
Right.
Sorry for being a bit long-winded about that.
And there is real first mover advantage there, right? Because it's the flywheel, right? So, okay, that makes sense. And I mean, they I've gone on about data a couple of times. The data thing really does make sense to me. I really, it astonishes me. I worked for a while for Experian, and those that know Experian, one of the world's largest credit bureaus and data companies and all that sort of thing. And working with them, it became apparent quite how much, if you like, digital exhaust we all throw off these days, especially with COVID having accelerated. All of the digital things that we interact with, as you say, we're thrown off digital exhaust that we may not even think about, the location of our phone, the times, all that sort of thing. I think it throws up some interesting regulatory challenges, but we won't go into that here. But the data play makes sense to me, and the first mover thing makes sense to me because I guess the thing that I've been sort of constantly looking for selfishly, because it's what drives the sale of our technology, it drives people to buy our technology, is a sense of urgency. And very much at the moment, there are a number of organizations that are kind of like, yeah, change is coming, but we'll wait till it threatens us, sort of thing. And my argument is, you don't understand the scale of the change you need to make. I mean, you didn't build Nexus in 6 months. It wasn't just putting together some technology in 6 months, right? I mean, it's a fundamental change, fundamentally different business model and that kind of thing. So
yeah, I mean, it took me about 4 years to pull this together, and it came with a very progressive management team to be able to make this bet, right? I can imagine, given and this is the problem with public listed companies and banks in general, is that obviously incentives for top management are generally structured on a short-term basis, and I mean, most people don't live to see out a 10-year bet. Most people won't be in employment of the same entity to see out the effects of a 10-year bet, which disincentivizes a strategic view. I agree with you. The pace of change is huge that's coming, and I think Thought Machine is doing offering an amazing solution with regards to scale. Because in order for this change to be made real, in order for any bank to do what I'm talking about, you need a core engine that powers at scale and be able to do, like I said at the very beginning of this call, tens of millions of concurrent transactions, not tens of thousands.
Yeah. So just to pick up that, Shang-Hong's asked a question about, you've talked a couple of times about Nexus powering other organizations. Just to drill in a bit more, what is who are Nexus's customers or target customers, to the extent that you're able to define, and how do they decide to BAS or to build, right? That kind of thing. What is it that Nexus brings? What's the power that Nexus brings? Is it just products? Or is it differentiated customer journeys? What is it that Nexus brings to your target market?
God, I'm not sure we have enough time for this one, but I'll do the simple one, mate. Nexus, and this is the one that makes all our partners understand it quite quickly. Nexus allows for you to become a bank without having to do any of the heavy lifting of becoming a bank to your customers, right? All the regulatory reporting, all the infrastructure, all the asset liability management, all the balance sheet management, all the risk underwriting sits with Standard Chartered. We have the scalable data and technology solution that allows for you to plug in and turn your front end into a banking capability. So tomorrow it could be, and I'm using those brands for illustrations, Google could plug into Nexus in StanChart and be Google Bank in all 36 StanChart markets. Right. I mean, it's not tomorrow. It'll take a couple of years, but it's certainly faster than applying for your own digital banking license and building your own tech stack and rolling it out in multiple countries, right? As we discussed earlier. So that really is Nexus. We pick our partners on the basis of scale and compatibility. So our first partner is Bukalapak in Indonesia. Our second partner is Sociola in Indonesia. We have conversations going around multiple countries and a couple of MOUs that have been signed, which we will announce at a far later date. But we're in production and we are waiting for public go live. So and to answer the question directly, when I say we power them, we allow them to become a bank for all intents and purposes. From the consumer, from the customer's perspective, they are a fully functional banking capability. Not so much that StanChart is only in payments, but an end-to-end banking capability that we're providing.
Right. So full current accounts, savings account, all of the products that you would expect. Okay. We'll perhaps kind of move on in the interest of time, because I've got about 54 other questions about Nexus, but we'll save that for maybe a beer sometime, or maybe we'll get asked for another session. So let's switch to the disruptive technology, or the technology underlying. I mean, it's an enabler. It's not a solution in and of itself. It's an enabler. in terms of, and I realize this hype cycle is slightly out of date. I couldn't find the latest one, but nevertheless, I mean, the two or three, you've kind of referenced some of them, but the 2 or 3 bits of technology you think over the next 3 to 5 years are going to have the most impact on the banking domain?
Yep, cloud infrastructure for sure. That is key because scalability is massive. It's the massive ask here. Given the increasing numbers of people who are underbanked, unbanked, or are market opportunity, so to speak. The standards and flexibility of the APIs are the next one, because that allows for the integration with the partners, integration with the vendors, integration with partners like Thought Machine, right? To be able to ensure that we drive out that solution comprehensively end to end. And I would say a slightly distant third would be machine learning capabilities to be able to run credit underwriting, to be able to run marketing use cases, campaigns, hyper contextualization for the end customers at the end of the day. That is a second order requirement versus the first two, would be my opinion.
Yeah. I mean, I think I'd align with those as well. I mean, obviously, I've left blockchain out of this whole thing. I think blockchain and DeFi and all those sorts of things is a whole other world. It doesn't mean they don't have an impact, but most immediately, I'd agree with your choices. I mean, one of the big challenges, I mean, I would never say this to Dennis Govan and his team, but you know, it's relatively straightforward to build a greenfield digital bank, right? I mean, so please don't tell him I said that's a secret between us and all the people on the call. But you know, it has its complexities, but you know, starting with a blank piece of paper has its advantages. If you look at like one of our customers, Lloyd's, which is basically publicly stated they're going to move their entire banking infrastructure to the cloud, based on, you know, us and a number of other cloud native technologies. If you look at that journey, if you look at that challenge, it's formidable. You understand why, you know, people aren't in a hurry to do it. But when I lived in the US, there's a place called Winchester House that I went and visited. And it was basically built, long story short, it was built by the widow of one of the heirs to the Winchester Arms fortune in, you know, early in the 20th century. She married him, they had a baby, they're blissfully happy, and then suddenly he and the baby died of natural causes. She kind of went slightly mad by the looks of it, went and bought a big piece of land and started to build a house. No blueprint, no architect, no designs, she hired every tradesman in the county, and they turned up every day, and she just built this enormous mansion. And you go inside it, and there are staircases running into walls because they didn't get round to building that wing. There are doors that you open that drop 3 stories because they didn't build that bit. There are, you know, chimneys, you know, fireplaces in the middle of hallways because she changed her mind. And it kind of really reminded me of kind of when you go in and look at a bank that's been around for 50 or 60 or 70 years, you look at their architecture, and it's the same, right? Because nobody started 50 years ago with okay, this is the end state and this is what we're building towards. You know, change happened outside the bank. Technology had to run to keep up. That change is accelerating. And, you know, you can often end up, you know, despite spending lots of money and having hugely skilled professionals, with something that's kind of held together with sealing wax and string. I think we have reached now the period where, you know, if you look at core banking, it was invented in the 70s when IBM released, you know, the first mainframe sort of thing. You know, we did a study with IDC last year that said the average age of core in Asian banks is 20 years old because nobody changes those things for fun. And you can actually, we've been able to get away with strapping other bits of digital around it to, to meet modern needs. I kind of feel like we've reached the limit of that because transformation, as you talked about earlier on, is accelerating. And it is time to re-architect banks, and it's no small feat. So yes, we have all this incredibly cool technology, I think cloud and APIs and all that sort of thing. But I think one of its most important capabilities is the ability to help a bank upgrade or reinvent its architecture and componentize and use APIs to incrementally migrate to a new end state rather than try and do some big bang thing. So I think for me that cloud and APIs is about not just what it can do, but also how it can help you get there. Right. And I mean, I think as you've built Nexus, right, you've got an incredibly modern platform that you have had to integrate back into Standard Chartered Bank, which has as I say, has spent a lot of money and has got a lot of highly skilled professionals, but is dealing with 70, 100 years of history. So I mean, is that kind of how you'd see it, that cloud and API and thing is also a mechanism to get to the future as well as being the future?
Yep, absolutely. I mean, we've publicly announced it, right? We are moving a lot of our components to cloud from the bank's perspective. Or take away the Nexus platform, but from the bank's perspective, all the existing infrastructure we have, there is a plan to move them into the cloud, including the core banking. There are obviously, as you are well aware, there are conversations that we are having with regards to what the future of that looks like. And Nexus is essentially built specifically to be deployment agnostic, infrastructure agnostic, so that it can be taken off and relatched onto what the bank has. If the bank has a fully scalable, modern cloud core banking system in the country that we've deployed Nexus, not a problem for Nexus to latch onto it, because Nexus is anyway cloud compatible and cloud native to a large extent. And where it is necessary to deploy on-prem because regulations, because multitude of different reasons as to why on-prem is required or public cloud is not allowed, or even private clouds are not allowed, then not an issue for that to happen too. So the specific special circumstances of the fact that SCB is in so many markets with so many different regulations and so many different parameters, and I wouldn't argue restrictions, but evolving capabilities, drove us to actually think about how do we build out Nexus such that we would be relatively ambivalent to these circumstances changing. It would require relatively minimal effort to adapt to them, and that's how we thought about it. And at this point, that's where we are.
Yeah. Okay. No, it makes sense, because I think the other thing is that if cloud and APIs and this kind of architecture is going to make a difference, what it needs to make sure is we're not just building next generation legacy, right? It is truly componentized, it's plug and play, and that agility is built into technical infrastructure, and we're no longer kind of constantly trying to patch and band-aid relatively monolithic systems, which I think takes us kind of towards wrapping up to try and wrap up on time, which is kind of drawing on all of our conversations. What are 2 or 3 things that you and I expect to play out in the financial services scene over the next 3 to 5 years? And I mean, as we've seen with Bill, either your words can get kind of misconstrued, or you can just get it horribly wrong, no matter how smart you are. My daughter gave me a riddle the other week, was what's right in front of you but very hard to see, and the answer is the future. But let's stake our reputations and pick 2 or 3 things that we think, what are we going to see banks really do in the next, let's say, 3 to 5 years. And I mean, incumbent banks, like, not blue sky digibanks?
I mean, I'm deeply biased, right? I think incumbent banks will realize that they need to start building embedded capabilities. I think in 5 years, the norm will be to consume, at least at the mass market level, will be to consume financial services in embedded ecosystems that people already use. I mean, I know I do. I know more and more people will, even the older generation. And I believe that offerings will become increasingly contextualized once the first wave comes through, which is going to be, I mean, again, I'm biased because of what I believe and why I'm driving Nexus, right? The reason I believe I'm driving it is because I believe that we will be embedded finance is the future. I believe that ecosystems and hyper contextualization is the future, and I believe that will happen in 5, if not 10 years.
Yeah. No, I'd go along with that. I'll bang my drum about data again. I think it is beholden upon any organization to find a way to get access to a broader range of the digital exhaust that we expel in our everyday activities, and then not just to gather it or have access to it, but quickly turn it into actionable insights. And I think there's some urgency around this, because where banks and credit bureaus, for that matter, and other incumbent organizations have had a stranglehold on that data, I genuinely think the regulator is opening up. So I think that moat of just having the data is no longer enough. It's how fast you can make it actionable. I'd agree with the contextualization. I think personalization is utterly key. I think Amazon and others are training us, even if I am kind of now the older generation. I mean, I'm trained to want my banking not just when I want and where I want, so mobile banking, but increasingly I want it how I want it, right? I don't, just telling me what my account balance is, just telling me that a payment was successful, that kind of thing is not enough. So if you add data and personalization needs into kind of, into actionable insights, what I'm looking for my bank increasingly, and I genuinely think should happen over the next 3 to 5 years, is using machine learning and AI to help me achieve my goals, right? I mean, I like to think of myself as a reasonably intelligent, kind of middle-aged white guy sort of thing. But if you ask me how well I manage my money, I'd give myself a C, right? I mean, because I'm so busy earning it, I haven't got time to learn how to manage it, properly. I mean, I do the basics on investments, all that sort of thing. It seems to me that a bank with all of the knowledge that it's got about me and about my peers and benchmarking, all that sort of thing, should be able to provide me with more nudges, daily nudges that steer me towards financial wellness. And I think in this sort of platformification world you've talked about, I think part of the dumb pipe argument goes away, that if you can take all of that data and become if you like, the trusted advisor, right? So you're not just providing the products and the capabilities, but you are providing insight, and that kind of insight and guidance would be kind of utterly invaluable. And I think the people that get that right, I mean, the speed with which robo-advisors came up, and that's not particularly sophisticated, right? You expand that out, and I think there's a huge kind of opportunity there. So okay, so it's been brilliant, Kelvin. Thank you very, very much indeed. I think for the audience, the reason for this slide is, what we have been talking about is happening now. If you are going to transform your bank, it's going to take you 3 to 5 years. Kelvin took 4 years to build Nexus, and that isn't because he was under-resourced and he's got a team full of dumb people. I've met them. There's a lot of really, really smart people there. It takes time, and it's not just about the technology. It's about the processes, the culture, the agility, the whole thing. And if you don't start now, you start in a year's time, it's still going to take you 3 to 5 or 6 or 7 years. And there's a quote from a Hemingway novel that I'm fond of, a thing called The Sun Also Rises. And a character in there is asked, how did you go bankrupt? And his answer was 2 ways: gradually, then suddenly. And I think if you look at digital disruption in other domains where it's more advanced, you'll see that that's how disruption happens, slowly and then suddenly. I mean, don't forget, for years Amazon was a joke, and then it wasn't. And I, you know, yes, Bill Gates, whether he's been misquoted or not, you know, was predicting the death of banks, you know, 20 years ago. That doesn't mean it's not coming. And I hope that what we've been able to sort of show the audience or in the discussions is some of the conditions, some of the trends, some of the opportunities, some of the threats. Yeah, I hope people found it interesting. It's been a pleasure. Kelvin, I look forward to buying you a beer to say thanks for joining me. And I'll
Cheers, mate. Thanks, mate.
Hand back to our IBF hosts.
All right. Thank you very much, Nicholas and Kelvin. All right, we've come to the end of today's masterclass. Hope you enjoyed yourself. If you want to stay connected with IBF, you may do so by scanning the QR codes here. With regards to the certificate of attendance, it will be sent to your registered email within 5 working days. Thank you once again for joining us. Till next time, goodbye.